Mullen Automotive stock dropped by nearly 15% today, closing at just 24 cents a share. That number alone is bad, but it doesn't tell the full story. Because underneath the surface, something much more serious is playing out. Let's start with the obvious: dilution. Mullen recently filed for the resale of up to 103 million shares tied to previously issued warrants, with exercise prices ranging from $1.44 to over $4.60. Those shares are now beginning to hit the market. This isn't just expected dilution anymore, it's realized dilution. It's happening right now, and the market's reacting the only way it knows how, with a sell-off. Today's price action, while ugly, coincides with a bump in the company's market capitalization, which has now climbed to roughly $4 million. That sounds like good news, until you realize that just days ago, MULN's market cap had plunged as low as $164,000. Yes, thousand, not million, making it briefly one of the smallest publicly traded companies on the entire Nasdaq exchange. So what's causing the recent recovery in market cap? It's not increased demand. It's not some breakthrough vehicle launch. It's the simple math of more shares hitting the float, an increase in share count, not shareholder value. Let's be very clear, this jump in market cap doesn't reflect business strength. It reflects dilution, pure and simple. And now, the pressure is mounting. Back on February 25, 2025, Mullen received a Nasdaq deficiency notice. The problem? Its market value of listed securities, or MVLS, had fallen below the $35 million minimum requirement, and had stayed there for 30 consecutive business days. In response, Nasdaq gave Mullen 180 calendar days, until August 25, 2025, to fix the problem. To regain compliance, Mullen's market cap needs to climb above $35 million and stay there for at least 10 consecutive business days. And today, they're at around $4 million. Let that sink in. They need to multiply their market cap nearly ninefold, and hold it, just to avoid delisting. This isn't a get-back-on-track situation anymore. It's a scramble to survive. Meanwhile, the company is still trying to present signs of life. They recently received CARB certification for their Class 3 electric truck, the Mullen 3, allowing sales in CARB-compliant states. They also acquired some of Nikola's equipment to expand battery production in Fullerton, California. These operational milestones are good, but they're not enough. Not when the stock has collapsed, trust is in tatters, and the dilution keeps coming. And to top it off, Mullen continues to pursue legal action against financial institutions, claiming stock manipulation through high-frequency trading. Maybe those claims have merit, but at this point, retail investors don't want lawsuits. They want leadership. They want stability. They want a reason to believe this stock still has a future. Financially, the picture is bleak. Revenue, $4 million. Net loss, over $524 million. Cash flow, deeply negative. Dilution, relentless. The fundamentals just don't support the valuation, the story, or the hype anymore. And so we're left here, watching a once promising EV company implode in slow motion. What started as a bold vision for American-made electric vehicles has become a warning sign to investors everywhere. This is what happens when dilution, debt, and over-promising collide. Could something still turn the story around? Maybe. A massive government contract, a buyout, or a miracle partnership could throw Mullen a lifeline. But betting on that now isn't investing, it's gambling. At 24 cents and falling, MULN is not just risky. It's a company that has to defy gravity, regain credibility, and rebuild almost everything just to survive. Thanks for watching. If you value stock coverage that's honest, not hyped, be sure to like, subscribe, and comment with your thoughts below. Retail investors deserve better. But right now, Mullen's not delivering.